Okay, guys and girls, it is Tuesday, the 9th of January 2024, and we are kicking off this year to make markets. But essentially, you're getting the Nvidia coming up on all-time highs there yesterday. But we've got quite a bit of data come through this week. Principally, it is going to be the core CPIs and the headline CPIs coming on Thursday. So this is the tier one events this week. Crude oil, obviously, tomorrow. But 1:30 GMT Thursday, we're getting the core and headline CPIs and initial jobless all at the half one marker GMT there. And then Friday, PPIs to come in. So this is really setting up for quite an interesting trading event. Setting up for quite an interesting trading event here on Thursday, given that the market priced in effectively 5 to 6 from the Fed for this year already, with the Santa rally that we had. And so, we're looking for on the headline year on year 3.2%. Prior was 3.1. So, if this comes in 3.3, 3.4, even 3.2, it might be a little bit of, turbulence in this market, because effectively it's going to feed into the Fed are probably going to have to step off of doing any cut, and certainly be reserved about putting cuts into the market, because they're going to want to remain cautious, right? So just keep an eye out for that. And the result, we'll talk about this when we look at the S&P chart in a minute, but let's push through here on data. Just a note on the CPI. This is kind of the shape of CPI here. Prior reading 3.1. Looking through this, here at the end, the target obviously down at 2%. We're almost there. Covered quite a bit more about this in my look ahead for 2024. Quite an interesting chart here from Apollo Academy Research. This is the overlay analog of the 1974 to 1982 CPIs and overlaid with where we are today on our CPIs. And so you're seeing that, we do have, if we are to follow the 1974 analog overlay, we have a lot more to drop and actually coming potentially below target in 2024. I don't know about that, but we'll see. But let's not get into the resurge of inflation that we had in the 1970s. That's a different kettle of fish. But do check out the look ahead for 2024 if you are interested in what I had to say about this chart here. The impact of the Fed pivot. I thought this was quite interesting for us to cover. This is looking at the 12-month forward expectations for consumers and where interest rates are going to be. And you can see that we are now bidding up here. We're heading up towards 30 on this, on the consumer's expectations of interest rates to drop, right? And so you can see here that over the next 12 months, consumers are saying that interest rates are going, more and more consumers are saying that interest rates are going to drop. However, if we look back at every other period where this really sort of peaked, you can see that it was the bang start of a recession, absolute start of a recession. So just do be mindful of this chart. So this is 12-month expectations consumer. I'll post a link to this in the about for this feed. Just thought it would be interesting, as we had non-farm payrolls come out there last week. I just see that we are net revising down month on month for these readings, and so the net addition of jobs it's not a net addition of jobs. And I don't know where this is going, but I feel like this is a bit of a canary in the coal mine of the slowdown, right? So let's move on. So big news this week. Boeing obviously it's not having a good week. Video circulating online of the Alaskan Airlines hatch blowing out the door soon after takeoff. That wouldn't be a great start to a flight, but nonetheless, we have one of the traders in here is actually an aircraft maintenance engineer, and very experienced engineer. And we were talking with Paul about this, and it's on most media airwaves now that there's really two ways this problem is going to shape up for Boeing. It's that one, this was an isolated incident where this was just a maintenance fault on that singular Alaskan Airlines aircraft, or the other side of this is that this is actually a design flaw in the entire fleet of the 737 MAX planes, and that they're going to effectively have to do a recall on all the planes. What you need to be mindful of is if they have to do a recall on all these planes, that's just going to hurt their bottom line for many years going forward. They're already ex-dividend. So they're looking at the Boeing chart here. You can see monthly bars on the left, and we're looking at, what do we have, 30-minute bars here on the right. We had that gap down of about 9%. Was it yesterday? and we just held below the sort of level here of $232 being pretty decent resistance. And I think when this is all said and done, I think we're going to be down at 139, which was essentially the high from February 2015. A really nice little level there for us to come down to. And if you ask me, we're going to $77 on Boeing. Now, this is a problem for the Dow, because the Dow is actually, I think, a 3% weighting. 3% weighting on the Dow Jones index. So that is going to drag on the performance of the Dow, obviously. Now, yesterday we didn't really see that transpire on the Dow. In fact, we bid up from the European market time into the open and into quite a nice update for the Dow. So it didn't really translate into much of a do for that. Okay, something else I wanted to talk about here is freight rates. Okay, so we're looking at the Drewry's World Container Index here. This is for the week of the 4th of January, and you'll see down here the freight rates, Shanghai to Rotterdam, skyrocketed, which says here 115% to $1,910 from $1,910 to $3,500. Okay, so these rates are on the upside because of the risk in the Red Sea. However, something you have to be mindful of now that if you're in shipping, right, if you're in any shipping companies, is there is going to be an addition of 11% the existing capacity this year added. Okay, so there's going to be a lot more capacity added onto the global shipping network this year. Currently, the utilization rate on global shipping is only 70%. So they already have 30% spare capacity, if you like, for transportation, and they're adding another 11% this year. So the bids up you're seeing in some of these companies like Zim, for example, Zim Shipping, or Maersk, or any of these guys is getting hammered now. So we're up about 30%, for example, on Zim. If we just zip on over here and look at, say, Zim, right? We've had, this is the month, really good month for Zim. But then yesterday, a bit of that getting priced in that, while they might have positive earnings, for the first half of 2024, can they sustain this higher income throughout the year, as there is can the rates sustain at this higher level based on the Red Sea risk, yet they're adding, additional capacity on there. I mean, I think so. The additional capacity will just be tagged on at a higher rate, I think, is at these elevated rates, right? And so that's going to basically impact a positive bottom line for the likes of Zim or Maersk. But just wanted to know, I'll put a link to this on the commentary for this video. All right, time to talk about oil. Big downside yesterday seen in the market starting at around 10 a.m. GMT, because Saudi Arabia was cutting its February Arab light crude prices to Asia. So what this means is effectively net is that OPEC has been coming in with these cuts and sustaining now the cuts to the end of Q1 in 2024. There's 2.1, I think, or 2.7 million barrels a day worth of cuts in the oil market, which you would think would be really positive and bullish for oil. However, the market quickly priced in, this is back in early December, market quickly priced in that, what was going to happen at the end of Q1 when effectively the cuts were going to be gone, and all the OPEC nations would have then effectively been able to produce as much as they wanted. The market quickly priced that point in, okay, end of Q1 information, and we kind of softened off on oil. Now, we've kind of been pushed and pulled between the Red Sea risk and what may happen at the end of Q1, right? One being extremely bullish, a scenario, the Houthi attacks in the Red Sea, the shutdown of transportation through the Red Sea, and then, a flood potentially coming onto the markets at the end of Q1. Coming above all of this, okay, overriding all of this is that you have US oil production hitting back towards all-time high. Now, the number of drilling rigs is not increasing. They're working down what are called DUCs, drilled but uncompleted wells. So these are wells that are ready to pump. They've already been drilled. You don't need to send another drilling rig out there. You just send out a production rig, or you just tap into it with a truck, and then you take the oil away, right? And so production is now increased without an increased activity in drilling rigs. A lot of people, a lot of oil traders that I follow and talk to say that, this is fine, but it can't last for very long at all. However, the medium term tail of this is that the market is really exposed, price is really exposed exposed to this increased US production level of oil. Whether it's sustainable or not, no one really knows how long they can keep going through these ducts and keep the production level high. But effectively, you have Saudi Arabia and OPEC cutting to create tightness in the supply. Meanwhile, and that's keeping price up. Meanwhile, the US oil companies are saying, great, we have, above $70 on oil on WTI. We're gonna just as much as we can out of these drilled but uncompleted wells and get that to market and just get it out there super fast. And that keeps their shareholders happy. It keeps everybody happy, effectively, who's involved in the company, right? No capex. You just take what's out of the ground and put it out market. How long can that last? I think the drilled but uncompleted can only probably last and probably to the end of this year, 2024. But that does give us a big overhang of price pressure. That we're not going to be able to have a really strong rally above 70s with that going on in North American production. The only thing that can rally us really from where we are, 72.50s right now at market on G24 on oil, DLG24. The only thing that can rally us up really here is increased Houthi attack, increased shipping problems in the Red Sea, etc., etc. But that's kind of already into the market a certain amount now. If we get a shutdown of the Straits of Hormuz by Iran, for example, then I think we're up $10 within 2 sessions. But we're not getting that so far. Okay. Here's a little bit more color on how most traders are cautious in the oil market and energy market at the moment. And okay, so looking at the sort of bigger charts here, as I was talking about on the S&P 500, we can look at the daily bars here. These are non-back adjusted highs here, the 48.08. You can see we've made a new all-time high non-back adjusted here at the 48.41.5. For me, I've been talking about we need to push back down to that Mark 2 high at 46.31s. And indeed, at this trend that we broke out of, maybe 45.86 is around here. And then you're into a really decent situation for a long, I think. But for now, the market's pretty weak until we probably get to Q1 earnings, I would imagine. And then we can probably get that rally and go in further upside. But yeah, for now, I think, back down 47.46s. Here we go. Back down to 47.46s on SPOOs and lower. Okay, and lower. That's S&P 500. The Dow, as you can see, the Dow has been putting up a decent fight yesterday. These are daily bars. But again, I think maybe we do get to 38.280s, the back adjusted prior all-time high. And then we kind of peel back. But I do think we just need to come back and test that 36.832s level at some point here. Do we have the environment for major dip buying on Boeing? I think that's what we saw yesterday, but not in a huge way, as you saw from the chart that I showed at the top of this recording. Let's look at oil. Oil's really weak below this at 73.30s. We were looking at 73.79s on yesterday, and on Friday we were looking at this level. But actually the bigger level, we were looking at was this back down here, 27th of November 2022, right over here. This little level here seemed to be getting traded out quite nicely as we were kind of end of last week here. So shorts off of that seem to be coming back right now to look at that 73.30s here and maybe 73.60s. But then I don't really see what can take us back over. I think there'll be a nice short in this area to then get down to 66.60. Yes, that is right, 66 on WTI. All right, what are the bonds doing? Well, I've been talking about the bonds being long this year. Especially look, I think I like the long on the bond. I think a lot of people have been buying all the way down for sure. But I don't know. I think just the defense line here is like probably 108.28. As you can see, I've marked it up here. 108.28 on T notes, and then we can go for 114.30. But as always, I'm staying nimble. I'm currently not in a trade on bonds. I'm waiting for something kind of weird to happen. What else? Nat gas is doing quite well at the moment. As you can see, it's had a hell of a couple of weeks there. Going back to the start of December. Joined in on that Santa rally, get on up. Here's the major zoom out on nat gas. So you've seen from contact over here, that's back to 2020, June 2020, and then a second contact point over here, February 2023, and that gives us our trend. And we got a contact on that trend there in April just last year, and we seem to be lifting anyway. So I think gas is going to have a really good year. So chuck that in the trades for the year. Long nat gas up to 3.902s. We'll just mark that level. What else? Dollar. Actually, no, I'm not going going to talk about dollar right now. I'm going to talk about gold. So we were looking at this trend yesterday, came in there pretty much around the 2020s. I don't think we actually got 2020s as a price, but you know, you could have been looking for a decent trade there on gold, yeah, for the bid up based on this trend. To me, it looks like it may break down at some point, but for now, it's supported on this trend, and I think we may go for another assault on the 2085s, which is the prior all-time high, and into, well, test this trend at 2100. So keep your eyes out for a test on gold. I'd be long gold this week, sure. I wouldn't be holding that trade over CPIs. I'd probably try and get into something just after CPIs. So do keep an eye out for what we're going to get on Thursday over the CPIs. We'll be live here in Doug Capital with boys and girls. And yeah, listen, stay lucky out there and have a fantastic week, guys. All right, cheers.